welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Senior Portfolio Manager and Chartered Market Technician. So thankful that you gave us a few minutes here where we've got a few topics to go over with you of importance. We're going to talk about the labor market. It's been kind of teetering at an important level for several months now. We'll give an update on that. We'll take a look at earnings now that we're through the bulk of the reporting cycle for the S&P 500 companies. And then Andrew we'll give an update on sector leadership and what we're seeing in the early stages of 2026. So let's go to the labor market. So one theme that's been present over the last several months is the government shutdown that happened late in 2025 has influenced all sort of reporting numbers, and that is trickling through over to this year as well when we had a little mini shutdown over the weekend. But one of the reports we've got on that side is from the Challenger firm, which gives its statistics regularly. Most of the focus is on the government's big job report that is released at the first Friday of every month. So we'll have that report between the time that we record this and the time that you're reviewing it, and we'll have more color. But right now, the tea leaves aren't great, at least from the Challenger report. You can see here, the January data is black, along with other Januaries from the prior few years. And January is typically a big month for layoffs. A lot of companies do annual planning towards the end of the year. They come up with plans and then they're implemented and often come with some job cuts. So it's not unusual that you have an elevated number in January, though this January is more elevated than we have seen in the past few years. So whether or not this translates into the government data, we'll find out. But this comes at a critical juncture because the job growth slowed close to zero. Between 0 and 50,000 is kind of home base right now. One thing that we haven't seen so far are layoffs. All right, so this is something that we obviously don't want to see continue, but it also points to maybe some validity behind the Fed members that do want to see rates come down quicker. They view it as the Fed's job to get in front of this, to get interest rates down, and to lend support to that labor market. So we will see on that front and hopefully get more color from the government data. Next year, we're going to talk about earnings. All right, so we're not all the way through the reporting of the S&P 500 companies, but through the majority of them. And we're seeing some really good signs in that we're looking at here the percentage of those who have earnings rising over the prior year. And now we see a vast majority of them are seeing strong earnings growth, which wasn't the case over the last several years where we were time and again led by a smaller subset of the S&P 500. So seeing that broaden out, at least for the time being, is translating into broadening out of stocks and seeing shares at other sectors and smaller companies doing better. So I'd love to see this trend continue. It certainly has some legs to continue as long as the economy stays at least modestly growing. So Andrew, I will pass it over to you to take a look at the sector leadership.
All right, thank you, Adam. So as we start getting into the second month already of 2026, as long as January felt, we have seen some big rotation within the stock market, looking at the sectors and some specific industries. So last year, the big topic, we discussed it a lot in the Market Carver, and for the last couple of years as well, has been the reliance and support from the technology sector, specifically a lot of those software stocks. We saw a lot of money flow into this area of the market. That's where we talk about a lot of the Mag 7 and a lot of just the adoption of AI and how that was going to just be this next catalyst for the market to move higher. Well, we actually saw now AI is having a negative impact on actually some of the stocks that they thought were going to be a benefactor. It used to be they would tell kids in school, if you want to be successful, you need to learn how to code. You need to learn computer code writing. And now that we have AI, they've found that, well, AI can do the code writing for you. And a lot of these software stocks are taking a hit because of it with the release of some of the new AI platforms. And so what we're seeing is now a rotation within the sectors, going into sectors that hadn't gotten a lot of love for quite a while. Names like energy, materials, consumer staples. It's been a while since we've seen Campbell's Soup being a company that's one of the stronger performers year to date. Meanwhile, we're seeing those prior leaders, again, technology, specifically those software names, are under pressure. You can see on your screen here, this is looking at the year-to-date performance. Software down, actually at one point was down over 20%, saw a bounce at the end of last week, now down 17. Meanwhile, we're seeing sectors like energy actually up 17%. This is why we really like to take a fairly active approach and really monitor what's happening below the surface of the market and where leadership is showing up, because we can't always just trust that what worked for the last year is going to continue to be in favor going forward. And so we always want to be evaluating where strength is showing up in the market. That's why we use a sector rotation model, where we're constantly looking at the data as we do start to see some of these movements, and looking at where the market is shifting. Now, this is a very positive sign for the market. There's an adage that a bull market's lifeblood is, or that sector rotation is the lifeblood of a bull market, that we continue to get new, fresh blood, so to speak, to continue to move the market higher. And rotation is very healthy. And that is true. The one caveat to that is when we saw this rotation take place, we saw the broad market is kind of stalled out because of the tech names that are such the majority of the market. When they begin to just slow, not actually go down, but slow their ascent or just stop rising altogether, then the market kind of has that weight around its neck. So while we're seeing actual individual sectors do really well, the fact that tech has begun to slow down has put a little bit of a hindrance to the S&P being able to move higher. Now, it's not declining. We're still sitting barely off the all-time highs, but those tech stocks do act as a weight, counterbalance, so to speak, to a lot of this strength that we're seeing in other parts of the market. So from a broad index perspective, this can slow things down. But when we start looking at active management, what we do at FEG, this can be a positive sign, as it gives us the opportunity to look for strength beyond just the passive indexes or just the few stocks that are the largest weightings. So this is something we continue to watch all year long, really looking for where strength shows up in the market.
Yep, absolutely. And well put, Andrew. Thank you as always. And thank you to all of you for giving us your time. We sure do appreciate it. If we can be of service, please give us a call, 800-928-4001, or scan the QR code and do so electronically. Thanks again, and have a great weekend.